Welcome to TheoTrade. This is Don Kaufman, June 23rd, 2021, doing the TheoTrade weekend update here on a Friday afternoon. Are these market distortions of epic proportion? I actually did quite a bit of research throughout the course of this week to see what is really driving some of these absolutely spectacular moves that we're seeing, not only in the S&Ps, but the Nasdaq specifically is where I've done some homework. I think you guys are going to find this quite interesting, quite entertaining, but I'm going to cut to the chase and tell you right now, we are going to be talking about just an epic gamma squeeze that is back underway in this marketplace. And people, this is what is going to be critical moving forward, especially given the fact that with this wild and woolly move that you've seen to the upside this week, yeah, that's prior to all of the major tech earnings that are coming out, of course, well, this next week. Let's get down to business here, evaluate the markets, and then again, talk a little bit about some of these distortions of epic proportion. First of all, hey, listen, the markets ripped to the upside again. Just a massive range, though, on the week inside of the S&Ps. And I wanted to start inside of the S&Ps because, again, the range in here is nothing less than phenomenal. And I'll show you exactly why it's such a phenomenal range. I mean, for the most part, we bottomed out here just below, 42, let's call it 42.40. And we ripped. I mean, on Monday, it was absolutely hideous. By, of course, Friday, everybody's high-fiving one another. It's a rip-your-face-off rally. There's a few key points, though, to be made over here. Number one, how many times in recent history have we seen both a breach to the downside of an expected move and the upside of an expected move within a given week? And the answer is, people, you can count pretty much on one hand in the number of years, in recent years, that this has actually occurred. And again, I mean, I've got all the data to effectively support this. It's not that we haven't seen, okay, multiple breaches of expected move. And for those of you, listen, I don't want to geek out on you too early, but expected move is how the option markets depict risk kind of on a week-to-week basis is what we're looking at in the expected move. And lo and behold, you can go back what, years of data. And here we are in the SPX. I'm going to tell you right now, okay, a breach lower and higher, okay, is such a critical juncture in the market. In fact, I just did a video recently. The markets are in transition. And one of the things that I was talking about extensively is you should see a dramatic increase in actual price movement in the marketplace. In fact, it was one of the key topics in last weekend's update, and it was the key topic on my Wednesday evening update, talking about the Nasdaq and how you can see it. Not only it's in transition, you should expect that the Nasdaq is just going to be rocking it. I told you I had no directional feel whatsoever. I think I'm as surprised as anybody to see it explode back to the upside. But this is 182 SPX handles. Why the big deal about it? Because the SPX, okay, the SPX, the expected move was $73. What do you say when the options market is saying $73? The actual price movement is 182 on the week. All you can basically say is the option market, it's not getting it right. And I keep reiterating this, that in the short duration, do not dare sell any options. We're selling options, and we're selling options very, very successfully in the back months where there's volatility. But in the short duration, an option seller is dead meat at this point in time. So again, just absolutely massive moves. It's what we expected. Again, the lower and upper expected move have been tagged in this past week. I just want to, for a brief moment though, compare and contrast. What does that look like inside of the Nasdaq? There was an interesting, almost like a tell inside of the Nasdaq. The Nasdaq on Monday didn't really sell off. It's one of the surprising things. And of course, the Nasdaq by end of week breached to the upside. Okay. Conversely, if we looked over at the IWM, which I've actually traded quite extensively in the last couple of days, the IWM did breach to the lower side and actually closed on the edge of the expected move. Nevertheless, if you look at week over week, the Russell is actually down week over week and has actually bounced over an incredibly important, and this is the IWM, the oh so important 210 level the 210 level inside of the IWM. You don't have to be a market technician to be infatuated with that 210 level. If you just take a quick glance here at the chart on a just a year-to-date basis, okay, we've actually been trapped roughly from 210 to 230 on a year-to-date basis inside of the IWM. That's a critical juncture. We bounced off of it once again. All right, so onward and upward. And again, I'm just trying to keep this brief as a little bit of a market update over here. Earnings, okay? The earnings that transpired last night on Thursday night, which of course were the earnings of Twitter, okay? Snap were the two that really, it literally shocked the tech trade back to life and in a huge way. So if you're looking specifically at the Nasdaq today and you're saying the Nasdaq just has a blistering move to the upside in today's trading session, over a 1% move, well, what sparked it? First of all, the Nasdaq was already on the bid, but it was some of these tech earnings that really sparked possibly part of the rally. But I'm going to tell you right now, and again, I said I'm going to cut to the chase here. It's the tech earnings, okay, were used, if you will, as a catalyst. Okay, I'm going to show you the actual trade though that's going on, and in some underlyings, it's shocking how transparent, okay, what we term the gamma trade is that is transpiring. And again, if you've never seen me explain a little bit about the gamma trade, it's back, and it's back in a big way. Huge gamma squeeze though going on in the marketplace. All right, one other aspect that we have to prepare for in this next week of trade. Again, I want to be forward looking in a lot of the statements that I make. All right, forward looking here, we're going to be dealing with the Fed. When I bring up the spiders close at an all-time high. The Nasdaq's at an all-time high. But okay, with the Fed in scope, and the Fed is coming once again. If you haven't looked at the calendar, yes, we get to hear from Jerome Powell, which will talk about, transitory. But there's just no plans at this point in time, it looks like, for them to actually reduce the bond buying, interest rates going up. The update to the dot plot should be negligible. Again, if the Fed's smart pretty much this time around, and they absolutely unequivocally are, they probably say absolutely nothing. And it kind of looks like when I tuned into implied volatility, it doesn't look like a huge amount's priced in. Okay. Nevertheless, one thing you have to keep in mind, the bonds are still a hop, skip, and a jump off of some of the recent highs, and the bond move has been dramatic. Okay. We are only what? 3 days, maybe 4 days at most removed, okay, from recent highs in the bonds. And those recent highs in the bonds panicked people, okay, that there was a market slowdown underway. And again, I just want to reiterate, and I say, between like 3 and 4 days. I mean, again, the bonds exploded higher on Monday. There was some follow through before they reversed on Tuesday, but literally from Tuesday when they hit, the 167 handle, they reversed. But you have to look at the bonds right now. They are still in a very precarious place, that any upward momentum inside of this bond market. And again, this is why I think that, the Fed's back in town. And I think it's a critical, point to be made for this next week is it's not about the Fed. It's about the bond trade. I'm not entirely sure how the bonds are going to react. But the one thing I can tell you, okay, a 2-point move to the upside in bonds, and all of a sudden, okay, all of those fears are going to resurface. Everybody's going to go, well, then it must be a slowdown. Okay, the bonds are at this point in time a massive momentum trade for the institutions. Like, you don't have to look at bonds and start to recognize it. People are going to come up with 50 different reasons. It's inflation, it's deflation, it's stagflation. I think you should push all of that aside. I really do. And again, I'll be very frank in saying I don't really care, what the marketplace is saying, other than that marketplace is straight up. Okay, you got to remember something about the bonds. The bonds, they do not adhere to the Dodd-Frank and the Volcker rule, which means that institutions are absolutely unequivocally trading the bonds directionally. And at this point in time, that direction and that bias is clearly to the upside. So a spike back up in bonds, it puts everything you're seeing of all-time highs, you're in such a precarious place at these all-time highs. Okay, and it's not that I'm not here trying to portray myself as bullish and or bearish in the S&P 500. All I am simply saying is, like, when you start to look at the picture, and in any way that you want to slice this, you can slice it and dice it any way you want, but any way you want to slice this marketplace, okay, we're 2 points away in the bonds from everybody starting to run and duck for cover again and being like, the sky is falling, the bonds are rallying, interest rates are going down, okay, a couple more years of winter is coming here. And that's one of the realities of the marketplace. And you're only, again, on Monday, we saw wicked sell-side activity in the S&Ps because of the bond trade. What a difference 3 or 4 days can make in a marketplace. All of a sudden, everybody's like, my fears have subsided. And again, I'm pushing aside any news, any thought of earnings, any, Delta, variant discussion. It's all for nothing if these bonds rally, okay? Fear comes back into the S&Ps in a big way, bottom line. All right. The next thing, tech earnings, okay? Tech went wild. Let's actually close this up a little bit. When I'm talking about tech, I'm specifically referencing the monsters of tech. Now, for those of you that have never seen the monster of tech symbol, I'm just going to highlight it here at the top of your screen, okay? Here it is in all of its glory. So this is not a perfect weighting by any stretch of the imagination, and I only update this symbol once or twice a year. And I do that because I just wanted to create a conglomerate index product. All right, so it's Apple, Amazon, Facebook, Google, Microsoft. People always ask me, why don't I add Tesla? Because Tesla has double the volatility of like a Microsoft, and it would really screw up my weighting. Well, why don't I ask NVIDIA, or enter NVIDIA in there? Because NVIDIA is the same animal. Then I would have to actually volatility weight. It would be ugly. One of the first things I want to talk about, though, with the monsters of tech, look at them on a year-to-date percentage. Year-to-date percentage. Okay, so on a year-to-date percentage, the monsters of tech are up roughly 31%. Okay, works for me. What's the QQQ doing? On a percentage basis, the Qs are up 19%. Okay, is there a problem with that? Well, again, are the tech earnings priced in? That's neither here nor there. That's for, I think, for you to decide. But some spectacular numbers came out. But those numbers weren't necessarily out of Google. Google's now up 54% year-to-date basis. Those spectacular numbers that came out were out of, for instance, Snapchat. Facebook actually was the beneficiary of both Snapchat and of Twitter. So Twitter barely rallied, but it's okay because Facebook exploded to the upside. And I just had to question before we get too deeply into this, is our tech earnings already priced in? And I think that that's up for debate in here. Now we're actually going to get to the crux of the this weekend's update, and that is distortions of epic proportion. And there are absolutely unequivocally distortions in the marketplace. I'm going to show you a couple things here. And some of it, again, I had to do some fairly, deep work at looking at particular underlyings versus other underlyings, which I'm actually going to show you here. But one of the important points to discuss is I have to explain a little bit about what a gamma squeeze happens to be, which I'll get to here momentarily. All right, so with that, distortions of epic proportion, the monsters of tech. And again, I already introduced you to the monsters of tech, okay? It's their market caps, okay, are why everybody believes that the distortions are prevalent. When I talk about distortions in a market, okay, and I talk about market cap, let's, for example, look at Microsoft. To come over here to this phase scores, open up stock highlights. Microsoft is roughly what? Let's call it $2.2 trillion company. Okay. So, all right, neither here nor there. What's Apple at? Apple's at almost 5 trillion. Let's look at Amazon. Throw a little Amazon in there. It's just shy of 2 trillion. Facebook hit $1 trillion market cap today. Of course, cap it off with Google. Google is just shy of about $2 trillion. That's it. That's your monsters of tech, people. Okay. This is why don't I bring Tesla into the equation? Tesla has a $600 billion market cap, but its volatility is double. So Tesla really is acting more like about close to a $1.2 trillion company, but neither here nor there. Now, you would think that the distortions here, just because of market capitalization, and one of the cool things is this, I kind of weighted the market cap over here. It's like $5 trillion, neither here nor there. Push all of that aside for a second, okay? One of the things that I have noticed, okay, is obviously, and it's very obvious that the percentage gains coming not only in the Nasdaq but in the S&Ps are in large part being driven specifically by the monsters of tech. It's pretty evident that the Nasdaq specifically, that all of the gains pretty much of the Nasdaq can in large part be pointed towards, the monsters of tech. Add a little Nvidia in there, and you're home, and that's where your returns are coming from the Nasdaq. Now, to get even more specific, okay, two things I want to show you. Number one, this is actually yesterday's option volume. And I'll come back to this again, and I just wanted to throw this in here, but yesterday's option volume was ironically anemic. That was yesterday's option volume, not necessarily today. And yesterday was a little bit of a rally, but the 2021 year-to-date average, okay, was closer to 40 million contracts. Yesterday we did like close to 31. Volume was off by almost 25%. So volume was absolutely unequivocally dead. Again, today volume actually picked up, but I've been watching, okay, option volume just with an incredible intensity, and it came back in a big way. Now, I'll bring this up again in just a few moments. Next on the docket, this is actually percent of total weight, okay, for the Nasdaq. And one of the things that I wanted to present to you is that, first of all, okay, that the top 10 companies inside of the Nasdaq, and I've showed this before, but the top 10 companies in the Nasdaq are worth approximately 53% of the Nasdaq. Yeah, but that's until you realize, okay, like Google just has like an absolutely immense weighting in here, and you have Adobe and PayPal, which pale in comparison. I mean, for the most part, like the top 8 stocks, hey people, this is where it's at. I mean, this is where it's at. The Nasdaq is owned in very large part, okay, by roughly the top 8 companies in it are over 50%. Now, I'm not telling you anything that you don't know, okay? So I'm showing you that, again, 50% of the NASDAQ comes down to basically 8 stocks. Okay, all right, so, but if you can move the NASDAQ and you can move those 8 stocks, can you move markets? And the answer is, of course you could. How is that actually occurring? This is actually the interesting part. The interesting part of this, and the reason I wanted to update you about option volume and so forth, and look at this move inside of the monsters of tech, is when I started doing a little bit of homework in this most recent up move, okay? First and foremost, we're going to look at a few of the monster of tech stocks, okay? And to do so, we're just going to glance at their option statistics. Option statistics. Look at the number of calls trading versus number of puts. Now, it's pretty evident that number of calls is outpacing number of puts, no question about it. There's nothing too crazy, nothing too unusual going on, though, inside of Microsoft. And what I'm highlighting over here, this is what we call the Sizzle Index. And on thinkorswim, and again, I worked back at thinkorswim for almost 15 years, and this is one of the items that I had a lot of input to. The Sizzle Index is today's option volume versus the previous 5-day option volume. So I looked at Microsoft. You know what Microsoft says? Nothing new, nothing unusual. Okay, like really, it's not too crazy. Yes, more calls traded than puts, but in effect, when you have more calls trading than puts, the way things work in the marketplace, and I'm going to teach you what a gamma squeeze is here in Microsoft, and then we're going to go on to a couple of other products. Okay, but the way the gamma squeeze works is you or an institutional trader, and I really believe that this is institutional traders that are actually doing this now. This is not retail traders, okay? They're going out there and they're buying, okay, calls. And in some cases, they're buying calls in epic proportion. And I'm just going to give you a quick example here. Let's go, okay, and literally buy, right? The 2, for instance, 90 calls. The 290 calls, we're roughly at 290. Buying the 290 calls have approximately, all right, a 50 delta. For those of you that don't speak option geek, pretty much all at the money options have about a 50 delta. So they go out there and they buy them, and they're going to buy 10 contracts worth. So 10 contracts worth of 50 delta, okay? That implies that if you went out and did this, you would be long 500 Microsoft deltas. Your counterparty, which is a market making firm, then in fact would be what? Okay, they would be short 500 Microsoft delta. How do they offset it? By turning around and buying, okay, 500 shares. Okay, they'll buy 500 shares, which gives them 500 deltas and offsets their delta to 0. So what does the market making firm get to do? They get to keep the difference between bid offer spread. So by you buying calls, or by an institutional firm buying calls, it actually in turn causes what? The counterparty, which is a market making firm, this is the market maker, to get short, and then they turn around and of course buy stock. But the irony is the second that they buy stock, the stock starts to move up. And before you know it, they have to turn around and buy more shares of stock to continue to neutralize what is an ever, increasing negative delta in here. And they buy more stock and buy more stock, and then we actually turn into this wicked kind of gamma squeeze, and we start to squeeze to the upside. So why I'm actually a little suspect of this, and where this becomes very, very evident, right, is that the monster of tech, the market caps have gone ballistic. The percentage moves are obviously like distorting, but the point that I'm trying to make over here, like, yes, the percentage moves inside of these monster of tech stocks, they're distorting all the index products, but the driving and the key to this, like the key driver behind all of these moves, it's the option market. The gamma is actually controlling all of the order flow and the outsized moves. This looks absolutely unequivocally intentional. And I'm actually going to show you what I mean by this. So I was looking today at Facebook, because obviously Facebook has just a rip and move by 5%. It didn't have earnings. It thought about earnings. Look at the option volume in here. Now remember, I just told you, yesterday we only traded like 30 million option contracts total yesterday. Today we're probably over 40 million. But one product traded 1.2 million contracts. Wait, what the? Think about this. Facebook, if we only did, let's get crazy. Let's say that today we did 40 million contracts, yet Facebook was a 40th of all the option volume that exists in the marketplace. And they didn't really trade puts, they pretty much just traded calls. And the sizzle index is almost 5 times the norm. That means we're trading almost 5 times the normal option volume versus the previous couple of days. So what do? You buy calls, it forces them to turn around and buy stock. When you buy stock, you have to turn around and buy more stock. We're in a gamma squeeze right now. We're in a huge gamma squeeze. Check this out. Then I started looking around a bit more into this, and I'm like, well, how crazy, how manipulated can things really get? Well, you know what I noticed? Like in Apple, Apple did finish up, but Apple wasn't like staggeringly higher. It was only up basically like 1.2%. What I found inside of Apple, yes, a lot of calls traded in here. Look at the sizzle. There's nothing going on. Apple clearly was not like a heavy, intruder, if you will, today on this kind of gamma squeeze. What's going on though on a day-to-day basis is they're like literally playing like musical chairs. Today was Facebook's day. Maybe tomorrow will be, Apple. Taking a quick glance over at Microsoft again. Microsoft, totally normal option volume, only 1.2% move. Then we start looking at stuff like Google. Now Google, this is huge, in terms of, by the way, there's Google and there's Google L. I'm looking at Google L specifically. You're seeing the exact same type of trade action in here. The percentage move, outstrips almost everything other than, of course, Facebook. So you're seeing it inside of Google too. Google, 3.5% move, trading almost 3 times the number of options. Wait, there's much more going on in here. I was looking, again, not just at the monsters of tech. I was looking off the peripheral. Anything of size right now almost feels like it's being manipulated to the upside by these squeezes. You want another wild one over here? Take a look at something like Starbucks. Now, Starbucks, this isn't exactly a mover or shaker. This is not something that would ever be on somebody's radar screen, except look at the number of calls trading versus puts. Starbucks does 100,000 contracts in here, which is almost 2 times the number of calls, about 1.5. Again, it's not crazy, but this stuff is very, very simplistic and very easy to pick up on. And one of the things that, I am absolutely saying for this next week of trade, we're going to be looking for gamma squeezes, and I'll get right on board with everybody else. If they're going to ride markets like this and they're actually going to make things stick out where it says, hey, it's 4 or 5 times the normal daily option order flow, you better believe everybody should hop on it, right? Hop on that bandwagon while it's hot. In fact, we could probably go out and sell some options out in the future to finance the purchase of options in some of these underlyings. It's just, again, this is chaos in movement. What we are seeing is clearly distortions, though, of epic proportion. And there's no question in looking at this, and again, I want you to be as objective as possible. It's not a healthy move for the marketplace. It's just not a healthy move for the marketplace when you have a handful of stocks obviously kind of running the roost over here. I mean, when you start to really put it in perspective, you start to bring up individual products here. and start to look at things like JP Morgan and so forth. And I was looking at a few of the bank stocks in comparison to tech, and the market cap of the bank stocks just pales in comparison to some of the big tech stocks. Again, you realize how distorted things really are. Last thing, something we always mention in each and every one of these weekend updates, SPX. The SPX expected move. This is one that, again, almost jaw-dropping at this point. We just came off of, okay, a $73 expected move. Now, net, what was the actual move? We were supposed to move $73 higher, $73 lower. We moved, okay, just past expected. It counts, people. It counts. We broke the edge of the expected move. And again, there's a huge, kind of takeaway from this. We have had just recently, look at the number of breaches, okay, in expected move. Look at the number of breaches. We had 2 consecutive weeks that we kind of mellowed out, but now we're back on the bid. So what we're effectively seeing, there's 1, 2, 3, 4, 5, in 6 recent weeks, okay, 4 out of the 6 weeks actually smashed expected move. I think you have to look at this coming week of trade with a $57 expected move. I mean, people, from low to high, we moved over 180 SPX handles. And now they contract the expected move to $57, and we have a Fed announcement. I am telling you, okay, there's a gamma squeeze going on, okay? The Fed is coming up. Short duration options have incredibly low implied volatility. Look, be a buyer of premium in the short term, be a seller of premium further out in time. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.